All right, recording now. Awesome. Again, thank you everybody for attending this meeting, this short notice webinar. I will be doing most of the presenting today. That will actually be Derek here from Ryan Tax Firm. I will, however, provide some disclaimers for you. Everybody's favorite part of the meetings. So this webinar is intended for informational and educational purposes only and should not be construed as legal, tax, or financial advice from MEA, the Maryland Administration, or from the Rural Maryland Council. MEA is not providing tax advice and cannot advise participants on how federal tax law applies to any specific project or organization. Today's presentation includes information shared by an external law firm with experience in federal tax incentives and direct pay provisions. Derek, say hi. Their participation is intended to provide general information and discussion. MEA's invitation to and collaboration with outside presenters does not constitute endorsement, recommendations, or approval of any law firm, consultant, or professional service provider. Finally, participants should consult their own legal, tax, and financial advisors to evaluate eligibility, compliance requirements, and the applicability of federal incentives to their specific circumstances. With that, I will hand it over to Derek, who will talk about ITC and direct pay for solar projects.
Awesome. Hi, everybody. My name is Derek Gimbel. I'm going to be talking today about the investment tax credit, or the ITC, including just some background on the ITC and the requirements, the direct pay mechanism for monetizing the ITC for tax exempt entities, and then the new solar phase out that was enacted with the One Big Beautiful Bill Act last summer. I'm going to try to keep it pretty brief, and feel free to jump in with questions at any time. So just some quick background about me. I'm a manager of green energy incentives at Ryan LLC. Ryan is one of the largest tax-only providers in the country, and they focus on mostly sales and use tax, property tax, and federal income tax. I'm in that kind of federal income tax group, since this is a federal tax credit. My background before joining Ryan, I was at the IRS Office of the Chief Counsel, so I actually participated in writing some of the regulations for these credits. I focused mostly on the advanced manufacturing production credit, which is kind of the flip side to the ITC for suppliers of solar panels and kind of related equipment. But I did dabble in a lot of the ITC notices and guidance that was coming out at the time as well. And I'm based in Philadelphia. My background's as an attorney, and I'm licensed in both New Jersey and the District of Columbia, and I'm admitted to practice before the U.S. Tax Court. So to jump in on the ITC is a federal tax credit that's for constructing or acquiring new qualifying clean energy infrastructure. So for some history, the ITC was first introduced back in the 1970s, mostly for wind farms and for natural gas infrastructure. And it's been extended and amended many times since then. So most notably in 2022, the Inflation Reduction Act really overhauled the credit framework for the ITC, added some lucrative bonuses to the ITC structure, and created some new monetization methods, which includes direct pay. And then more recently, the One Big Beautiful Bill Act last summer kind of walked back some of those expansions made by the Inflation Reduction Act, including adding the new solar phase out, which I'm going to be talking about in more detail quite a bit later. In essence, the ITC is really just calculated as a percentage of your cost, or the basis, which is kind of just a fancy word for your cost in the property. That percentage can range anywhere from 60 to 70%, depending on the type of technology and whether the property qualifies for any bonuses. There's kind of a common misconception that standard, ITC is a flat 30% credit, but it's actually not. And I'm going to go into some more detail on the next slide on how some of these bonuses stack. In general, most projects that I see fall somewhere between that 30 and 50% line. So just a quick case study here for a $1 million project. $1 million would probably get you somewhere around 650 kilowatts. So the base credit here for solar is 6%. And the project, but there's 4 bonuses that you can add to kind of increase from that 6% base rate. So the first one is the project bonus, which you can get really one of 2 ways. The first way is for the project to be under 1 megawatt. And then the second way is for the project to meet the prevailing wage and apprenticeship requirements, which really require you to pay laborers a certain prevailing wage that are set by the Department of Labor, and then also use apprentices on the job. A majority of the projects are under 1 megawatt, and especially for the municipality level that I'm seeing. So these types of projects would get the project bonus automatically. The second bonus is the domestic content bonus, which is a 10% bonus for using domestically manufactured components in the project. The third is the energy community bonus, which is another 10% bonus for locating the project in what's called an energy community. The IRS and the Department of Energy have published maps of the energy communities across the country. So I took a look, and it looks like Maryland doesn't have a ton of them, but parts of Washington County, Charles County, and Montgomery County all have energy communities in them. So that's a potential for an extra 10% there. And then finally, the low income bonus is a 10 to 20% additional bonus as well. This is for locating the project in a low income community. But unlike the energy community bonus and the domestic content bonus, which you get automatically by meeting the requirements, the low income community bonus requires you to apply to the IRS and then get selected to be one of the projects that gets an allocation of this bonus. So it ends up being pretty rare that you see a project getting the low income community bonus. I've probably helped with over 15 or so applications, and have really only seen one project get that bonus allocated to them. So if we kind of step back and look at the case study in big numbers, $1 million is the CapEx, or the cost of the system. So you'd get 6% for the base for solar property, plus 24% for the project bonus because the project's under 1 megawatt. And then this example project also met the domestic content bonus. And these are stackable. So that means that your overall kind of percentage for this project will be 40%. So on $1 million CapEx, that would end up being a $400,000 ITC. Any questions before I move on here?
It looks like we have a question from Chris Sims.
Yes, thank you. I did have a question regarding, since we're getting $1 million in funds from the MEA for the grant, is the tax credit percentage calculated off of just the physical out-of-pocket cost for the community, or does it include funds that would ultimately be reimbursed by the grant from the MEA?
It includes the grant amounts. It would also include if you use like tax exempt bonds to finance the project, those would be in there as well. Debt financing, all of that goes in to the basis and calculate the credit. I will, when we get to the direct pay slides later, I will note that there's a limitation on the amount based off of the amount of money you've actually personally put into the project in terms of debt, but I'll kind of cover that later. But in terms of the actual calculation of the credit, it's based off of the project cost, which includes grant amounts, tax exempt funding, things like that.
Okay, and just one other quick one. In terms of the basis, does it only include the capital cost for like the solar panels and the racks? Would it also include any like security fencing? Is that considered part of the project? Or is it just the physical panels and racks?
Yeah, it's funny. I'm laughing because you picked a poor example with the security fencing because that is specifically excluded under the regulations from being in the system. But there are a lot of other things that come in that aren't just like solar panels and racking. There's also, concrete for the foundation. There's labor costs, engineering and design costs, inverters, like electrical equipment that you're using to hook up like the wiring, all of that stuff would come in. Security fencing, and then if there's like any kind of maintenance roads or things like that, those are the two things that are specifically excluded from being in the basis, but everything else is essentially the way that I think about it is if it was necessary to put in the solar, then you can put it towards that basis, if that makes sense.
Understood. Yeah, no, that answers my questions. Thanks.
Yeah.
Awesome. It looks like we have a question from Katie Jester as well.
Go ahead.
Katie, I'm not sure if you're speaking, but we can't hear anything. All right, I think it's all right to move on. Katie, if you get your audio to work later on. then we can come back
Sorry,
to
I
you.
think I just got it. Is that
Oh, here we
better?
go. Awesome.
So on the domestic content bonus, have you
Mhm.
done a project where you've actually gotten that through? Or for the domestic content?
Yes, I have, but I'd say that it's challenging to find the right vendors.
Mhm.
At the moment, really the only way, well, there's kind of two different ways you can calculate domestic content, but under what I would call the easy method, the only way that you can get across the domestic content line is by having domestically manufactured panels with domestically manufactured cells, which are very, very hard to come by, and a lot of them are reserved for larger utility projects, like utility scale solar fields instead of some smaller projects. So they can be kind of hard to get your hands on, but there are other smaller providers who have solutions. And then my understanding from the industry is that a lot of different companies are working towards, like, it's a goal to have those products available maybe middle of next year. It's just, especially with all the OBBA changes, there was a major rush to get panels ordered, and especially domestic content ones. So it's really difficult right now, but before kind of the OBBA rush, I saw it a ton, and then I think that we're coming around to a more palatable place for projects that have some time to wait, if that makes sense.
Yeah. So are you recommending that the towns get a certification for that beforehand? Because the sheets
Absolutely.
say, manufactured in the US, but they don't have enough domestic content to actually qualify to push you across the line on a lot of them.
Yeah, absolutely. My recommendation would definitely be to get some type of certification from the vendor, whether that's a letter or kind of a worksheet where they fill out the domestic content thresholds on the on the equipment that you're purchasing. That's been a standard for the packages that I've put together for domestic content.
Okay.
I think that's all the questions for now, so you can move on to the next slide.
Awesome. So just some quick requirements. I can go over these pretty quickly, I think. So the first one is that you construct or acquire a new qualifying technology. So qualifying technologies include solar, battery, geothermal, wind, biogas, some cogeneration, hydroelectric, and then any other zero energy greenhouse gas emissions, or zero greenhouse gas emission energy source that the IRS approves would fall under that. So any solar project, really easy to meet that first requirement. The second one is that you're the owner of the eligible property. So the tax credit really only goes to the system owner. So that's just something to be aware of as well, especially if you get into some type of leasing arrangement or something with the solar property. And then two of them are newer exclusions that came from the One Big Beautiful Bill last summer. So the first one is the solar and wind phase out, which I'm going to be talking about in quite a bit of detail in later slides. And then the second one is the foreign entity of concern provisions, which really I think for municipalities like yourself, you can really think about it as you can't use too much material from companies that are incorporated in China or that have are controlled by owners or companies that are in China. There's more countries that are covered. I think Russia, Iran, and North Korea are, but none of the solar supply chain runs through any of those countries. So they don't really play too much into it. The rules are pretty complicated on figuring out who a quote unquote prohibited foreign entity is. But a lot of the solar providers have either moved their operations out of China and reworked their organization to meet this rule, or didn't have any concerns about it when it came out. So we've been finding that the FEOC is a lot easier to do the due diligence on than like domestic content, as Katie mentioned earlier. And then I would also add, just there are some other requirements. This isn't exhaustive, but these are really the ones that I would focus on for municipalities and tax exempt entities. But for example, another requirement is that it can't be a residential system. There's a different credit for that was also phased out under OB3.
It looks like we have a question from Nolani.
Yeah, so does the owner eligibility mean that this would not qualify if a locality was pursuing a PPA with a solar developer?
I think a PPA is okay for like they're just purchasing the power from you, or are you gonna like I'm just struggling because sometimes there's a structure where you kind of flip the PPA and sell the power back to the municipality to reduce the cost of the system. That's the issue that I'd be worried about. If you're just selling the power directly to some entity, then no, there's no issue there. It's not about the power, it's about kind of the system.
So if we're setting it up where we kind of provide the location, but the developer installs the solar and we're buying that power from them essentially, that
Yes.
would mean that this wouldn't apply, or it would?
It wouldn't. That would, I think in that case, it really depends on the exact contract terms, but in that case, it sounds like the solar developer would actually own the panels and would get the ITC for that portion. But again, it can be a little bit complicated depending on the situation and the contract terms. It really comes down to who owns it under like tax rules, which can get a little bit tricky.
Okay.
I'm not seeing any other questions, so feel free to move forward.
Awesome. And thank you, Lacey. I can't see anything other than my slides, so if you can kind of keep letting me know if there's questions, then that's great. Shifting gears here, I wanted to talk a little bit about the direct pay mechanism. So direct pay is really a mechanism for the tax exempt entities to be able to monetize the ITC. This was created as part of the Inflation Reduction Act, and before then, tax exempt entities really had no interest in the ITC or would have to enter into these they're called partnership flip kind of arrangements, sort of like the one we were just describing with the solar developer and the in the previous question. you had to enter some of these relationships to be able to monetize the ITC in any sort of way for tax exempt entities, because it used to be only a credit against tax. Instead, this new direct payment method allows tax exempt entities to essentially claim the amount of the tax credit as a refund from the IRS. The mechanics are a little bit more complicated than that. The IRS treats you as having made a payment of tax in the amount of the credit, which then entitles you to receive a refund because you've overpaid tax. But the essential treatment is that you get a refund back from the IRS. There's a few limitations and restrictions I want to go over here on direct pay. So the first one is really an eligibility requirement for direct pay, which is that a project is only able to use the direct pay mechanism if that project is either under 1 megawatt in capacity or it satisfies the requirements for the domestic content bonus. It has to do one or the other, or else it's not eligible for direct pay. I've seen a lot more systems go down the 1 megawatt route than the domestic content route, but obviously that depends on how big you want your system to be and some extra factors as well. Two other kind of limitations on the actual credit amount itself. The first one, this is kind of what we were addressing with the first question, where projects funded by grant do have a limitation on the direct pay amount, which is that the direct pay amount can't exceed the total project cost minus the grant amount. So in other words, really the amount that you can receive as a refund can't exceed the amount of money that you put into the project yourself. The amount of money that you put into the project yourself can include tax exempt bond financing, debt financing, tax exempt leases, things like that, but wouldn't include any grants. And then on the flip side, there's a reduction to the credit amount for ITC projects that are financed by tax exempt bonds or a tax exempt lease. So the reduction is equal to the minimum of the percent of the project financed by one of those tax exempt vehicles, or 15%. So for example, if 10% of the project financing came from tax exempt bonds or a tax exempt lease, then you would reduce the credit amount by 10%. But if 50% of the financing came, like 50 came from a tax exempt vehicle, then you would only have to reduce the credit amount by 15% of the credit amount, because that really serves as the ceiling for the reduction. So those are just some limitations to be aware of that kind of come up with tax exempt projects and the direct pay mechanism. As just another note on this kind of tax exempt bonds piece, the reduction comes out of this bottom credit amount. It doesn't come out of the percentages. So in this example, you would still have a 40% tax credit on the 1 million. And then that would lead to a $400,000 credit that is then reduced down by 15%. So 15% of that's 60K, I think. And then if I'm doing my math right, and then that would lead you a $340,000 tax credit with a 15% reduction. Tax exempt, or sorry, the grant limitation would work similarly. Say that you had $300,000 of your own money in this project and $700,000 was funded by grant, then you would still have $1 million CapEx, a 40% credit, which would get you down to $400,000. But then you're limited to $300,000 because that's the amount of money you have at risk, or that's your own money. So the credit amount in the grant case would be limited to $300,000. Does all of that check out? I know I just said a lot of math out loud, so.
I think everybody understands it perfectly because I don't see any questions.
Awesome. And then here's just a quick kind of timeline on how direct pay works. The first step is obviously to invest in that solar facility. So whether that's by grant, bonds, debt financing, however you do it, you make the investment. Next thing is that the facility is constructed and placed into service, which is really just a fancy word for saying that it becomes operational. The next step would be to register the credit with the IRS. All credits that are going to be direct paid need to be registered in advance. This process usually takes about 6 months to get a registration number that you then put on your tax forms. So it's pretty essential to get the credit registered as soon as you can, right after the facility is placed in service. After you register the credit, then you claim it on tax forms that are filed with your information return for the tax year. Once the claim is filed, the IRS reviews that claim, and once the review is complete, then they send out the refund. The review process I've seen take somewhere between 6 months and a year for smaller credits, and then up to maybe a year and a half for credits over $1 million. The overall process from time that you place in service to time you actually get your money usually ranges from about a year to 2 years. And there are different ways to kind of monetize the credit beforehand for some discount on that return. I think I know Ryan offers some services like that for direct pay. Any last questions on direct pay before I switch gears to the solar phase out?
Yes, we have a question from Natalie.
A question on municipality. We're not tax exempt municipality. We're a small municipality, town of Berlin, on Eastern Shore. And is that something that could be potentially applicable if we're looking to purchase solar panels to basically offset the cost of utilities for town hall or wastewater plant or a facility within the town, or that's something really minimum?
Yeah, even if it's a small claim, that there's no real limit on size for direct pay, both for size of the entity claiming it and size of the credit. So if it's a small project, that's not a big concern, and it actually kind of helps with not having to go down the domestic content route and not meet PWA and other kind of basically the process can be simplified a little bit for some of these smaller projects. And then also as a small municipality, that's okay too. The entities that are allowed to use direct pay to claim the tax credit is very broad and includes, municipalities, state government agencies, nonprofits. It's a pretty broad list.
So my confusion comes on the IRS claim. Since we're not filing 990 form and we don't claim or don't pay federal income tax, how's that going to work?
Yeah, so I'm not exactly an expert on like tax filing or information return filing for tax exempt entities, but I do know that in terms of claiming the tax credit, you do have to file an information return for that specific tax year, even if you haven't done it previously or aren't planning to do that in the future. It has to be claimed on an actual information return. And if your return somehow kind of bundles up to another state level return or something like that, then it would be filed on that entity's return. Does that make sense?
It does. I think it's more applicable to tax exempt entities. Municipality is not a tax exempt, not required to file 990. So that's where the confusion. You said that yes, we qualified, but I don't see how the process, like a step 5 or step 4, would work for us to claim a refund.
I'm not exactly sure what the requirements are on filing for tax exempt entities. We do have people who at Ryan who work with tax exempt entities on doing the filing for these types of credits that are, but I do know that municipalities are able to claim the credits and have a method. I'm not exactly sure what general information return is filed that you append all of the forms to. I could ask one of my colleagues, but I do know that it is possible to file for a municipality that they were kind of one of the targets for this direct pay mechanism.
Okay, well, if we can follow up maybe on step 5 about the informational return for municipalities that are not exempt.
Absolutely.
Thank you.
Yeah, that's a great question, Natalie. I don't see any other hands raised, so Derek, you can. Oh, just kidding. We do have a question from. Hopefully, I'm pronouncing this correctly. Abdullahi.
Yeah, Abdul
ahead.
for short. Nice to
Abdul,
meet you, Lacey.
thank you. Go ahead.
Just a question in terms of the registration process. Now, can we register with the IRS before placing the, I guess the asset into service?
You're not allowed to. I'm honestly confused as to why, because it would simplify things on timing quite a bit, but no, for some reason there's a requirement for registration that the asset's already been placed in service.
Thank you, Derek.
Great question. I don't see any other hands raised, so feel free to move on, Derek.
Awesome. So switching gears here a little bit, the last topic I wanted to cover is the ITC phase out for solar and wind projects. So I've hinted about this a couple of times, but the OB3 legislation last summer terminated the ITC for both solar and wind if they don't meet one of two criteria. So the first criteria is, option 1 would be that construction on the facility begins before July 4th of this year. So like within the next month and a half. Or alternatively, that the facility is placed in service before January 1st of 2028. So I'm going to jump into a little bit more detail on what this means and kind of how these tests work. Especially beginning of construction, there's 2 tests, and the physical work test and the 5% safe harbor. I think that the physical work test probably aligns with what you think of when you hear beginning of construction. The physical work test essentially evaluates what was the first day of significant physical work on the job site. You can see I've put some examples of significant and insignificant physical work below, but really the main kind of gist of these is that preliminary site work and preparatory activities won't count, whereas, real labor to install critical systems or foundations, things like that will count towards physical work. But I'm not going to focus too much on the physical work side, because I think that with it only being a month and a half out for projects that are in early planning phases, it'll be very difficult to get physical work over the line. But your other option is the 5% safe harbor, which is, a little bit more flexible test and might be a more attainable option for projects that are in the planning stage right now. So the 5% safe harbor is, really just a calculation of the date on which 5% of the total system costs were incurred. So whichever date that is, that's the date that construction is deemed to have begun under the 5% safe harbor. So just kind of walking through a couple examples for $1 million project here. If you signed a binding executed contract to purchase, $80,000 of material, that would be 8% of your project costs, and you'd be safe harbored under the 5% safe harbor. Similarly, if you put down a 5% deposit on a construction contract, that includes, the entire cost of the system, the labor, all of the things that you were going to be adding to the basis for this project. Putting down a 5% deposit on that construction contract could get you over the 5% safe harbor line. Or, you could purchase a system that has been previously safe harbored by a solar developer or some third party and you could even make this purchase after July 4th as long as the system had been safe harbored prior to the July 4th deadline. So essentially, the 5% safe harbor is a much more flexible test that could allow projects to get in under the line before this July 4th date, which is very quickly approaching. Two caveats I will throw out there about the 5% safe harbor. The first one is that it's only available now for projects that are under 1.5 megawatts. And the second is that the 5% safe harbor is, you have to really use projected costs to find where you're at 5%. But the actual rule is based off of your final costs. So I always recommend building in a pretty good contingency, maybe shooting for 8% or something like that to avoid having cost overruns take you out of the 5% safe harbor and potentially put your project at risk.
Any questions based on the beginning of construction tests? All right, I don't see any.
Awesome. Then we can jump in, and then the other kind of half of this test would be the place in service, or not the other half. The other kind of option for meeting the termination dates, it would be meeting the placed in service deadline. So if a project doesn't meet that July 4th deadline of this year, it doesn't mean that they've lost their eligibility for the ITC yet, but they have entered kind of a race against the clock now to get construction done, because the construction must, the facility must be complete and placed in service by December 31st of 2027. In terms of placed in service, really that just means that you're in a state of readiness to generate electricity. It doesn't have to, the system doesn't actually have to be energized and producing electricity yet. We generally like to use commissioning date because it's very provable as the placed in service date. But if you were running up against this deadline, as long as construction was complete, and then when the system was commissioned, you didn't have to do any additional work, you could use the end of construction date, because that would be the date that you were in a state of readiness to generate electricity. I'm highlighting this because there's really no justification for missing that placed in service deadline. We very commonly see on these solar projects permitting delays, construction delays with commissioning, things like that can really compress this timeline down and make you sweat whether or not you're going to get the ITC at all, which for most projects is a make or break. So that's kind of why there's such a big push on this to meet the beginning of construction test, because you've given yourself a lot more time to finish the system. It's not as urgent once you get that beginning of construction done.
All right, we do have a question from Lunsford. Lunsford, if you're speaking, I don't think we can hear you. I'll give it a few more seconds. All right, hopefully we can come back to you later once you figure out the audio. Any other questions on the placed in service deadline?
We can just kind of shift to general questions too. That was the end of what I had prepared. Just have my contact information back up on the screen now, but in case anybody missed it. But yeah, I'm happy to take any questions if you have them now, or if anything comes up later, feel free to send me an email. I'm happy to take a look at any questions that you have.
Can you hear me now?
Yes.
Okay.
Yes.
Just real quick. I want to find out, did you when you're talking about construction costs, and I know you mainly covered more of the physical labor, and most of the soft costs those were the ones that were excluded, like the legal costs and things like that. I think I stepped away for a second, so I just want to be a little bit clearer on that. Like engineering, architecture, things like that. Those things were excluded. Is that correct?
So not exactly. Most soft costs will come in. So engineering will definitely come in, environmental studies, all the site work that I was saying doesn't count for beginning of construction, all that still gets to come in for the actual basis. Developer fees, things like that all gets to stay in. The main soft costs that come out are like due diligence. Like, for example, if you hired Ryan to do all of your due diligence work for the credits and register the credit or something like that, then our fee wouldn't be part of the basis. Similarly, if you got like legal opinions on
Okay.
some of the stuff, then or
Consulting
contracting.
and things like that.
Yeah, and then the land value is also out as
Okay.
well.
Great.
Yeah.
Thank you.
No problem.
Any other general questions based on what we've seen so far? Awesome. Derek, I think that means you did a great job at presenting today. I know, Bob, you and I had talked before this webinar, and you shared that you had a great meeting with Leonardtown, and you'd be willing to share a case study example of how that went down with pursuing ITC. And James, I believe you were also involved in that. So I'll hand it off to you guys if you want to share how Leonardtown is pursuing ITC.
How about now? Is it working?
Mm-hmm.
Great. Yes, I do want to share a couple things. And then at the end, I wanted to touch base a little bit with the Rural Maryland Council item. But primarily, this program was put together to try to help the grant recipients on how they could perhaps take advantage of some of these safe harbor provisions and the like. And as an example of how you might be able to get some assistance working with these different local jurisdictions, there was an actual activity that occurred in the town of Leonardtown in southern Maryland. And I wanted to ask James to walk through what took place there and some somewhat, I thought, innovative approaches to helping that town get to that point where they could now get into the safe harbor when, for many jurisdictions, meeting some of the financial requirements when they were not originally budgeted for that year. And smaller jurisdictions, that can be a bit challenging at times. So I would kind of suggest or ask James Thorskamp if he would run through what took place at the hearing and the implementation phase of this at Leonardtown.
Sure, I can be brief. So we're actually a solar installer. So this is the boots on the ground. And there was a $650,000 grant that was given to Leonardtown. But there's more solar opportunities than we were originally looking at. So what we did is said, all right, if we can get this safe harbor, meaning that 5%, at least a 5% deposit, then we're going to be eligible for that 30% ITC. So we said, all right, if we do that, then we could do, let's say, $1 million worth of solar. And then we're looking at a $300,000 ITC with the $650,000 grant from MEA. So that's actually 950 of that 1 million's covered. And so what they had to do is move quick and sign an agreement and then give us the check to do that, safe harbor test. So 5%. So we can go ahead and secure the materials and assign the materials within a certain amount of time. It's 105 days. And so they're safe harbored. So that gives us till the end of 2030, actually, instead of to the end of 27 to do that project. So if you're able to do that, move that quickly and say, you can't wait till July 3rd and say, all right, we want to go before July 4th. It's really like, I would say it's getting close now. I'd say within the next couple of weeks. And I realize that everyone has provisions where they have to do RFPs and so forth. So they checked with Lacey and they were informed that there's no provisions that are inherent in the MEA program would say you have to put this out for an RFP. So if it meets your thresholds, your county thresholds or your municipality thresholds that say, all right, it's going to be less than 50,000 or 30,000, whatever the case may be, it doesn't need to go to RFP. You can actually design what you think is going to be the system, sign with a solar contractor, and then lock in that safe harbor. So then that, again, buys you time for 4 years to do the project, which I think is really realistic. And so there's also a timeline on this program. It needs to be installed by, I think it's mid-2029, if I'm not mistaken. Lacey would know. But is that right?
Yeah. For AOI 2 and 3, I believe the deadline was 2028. Yeah, because it was 2 years for those, and then it was 3 years for AOI 1. So if you're a county, you have 3 years, and everyone else will have to.
Correct. Yeah. So it essentially buys you time to do it longer. And then one other avenue that we used, which was enabling them to get below that threshold that they might have considered to have to put it out to RFP, was we purchased their renewable energy credits. When you own the system, which they will do, then they get renewable energy credits. So they can sell those up front. And then they're in fact, funding the other remaining 50,000 that they had to put out. So that brought them below the threshold. So I just want to say that it is very doable. I would recommend, just objectively speaking, that you consult with, say, Derek or somebody like Ryan LLC. So all the compliance can be in order. It's not an extremely expensive project to do that. So I would recommend that. And I'm recommending the same to Leonardtown and some others that we're working on. So that's the gist of it.
Now, just to be clear, what took place at Leonardtown, in order to go through that process to get into Safe Harbor, needed to come up with $50,000, correct?
Mm-hmm.
Or to meet that. The town has some, obviously they didn't necessarily budget for all of that. To help the town, as I understand this, you and your firm as the entity doing the work bought the SRECs for $50,000. And I assume you in turn will then sell those SRECs to keep yourself harmless. But that was a way for the local jurisdiction to quickly get the funding necessary to move forward with this. Is that a fair description?
Yes.
All right. I think that's something that I think is, I thought was creative. I thought because towns, particularly the smaller jurisdictions that have some budgetary restrictions and may have difficulty coming up with cash quickly, as an alternative, something to look at that's a little different. So I just wanted to make sure we got that across. And you, in your example, you're certainly able to meet the respective deadlines to achieve the safe harbor provisions, correct?
That's
Good.
correct.
Okay. Well, thank you for that.
Thank you guys so much for sharing that experience with Leonardtown. We've got a few minutes left, so Matthew, I'll pass it over to you.
And that's fine. Matthew's usually the one in trouble, which I could be after this question. So just to make sure that I understood Derek's slide, and then the example you provided, James and Bob, and I appreciate you guys providing the example to make kind of what was on the slide real. So Leonardtown, you got a grant from MEA for $650. You're looking to do $1 million worth of solar. So you're looking to take the safe harbor. So we had to come up with that difference of $350. In theory, like the numbers there to match, however they come together, financed or direct pay or whatever. So is the ITC only against and can't go above the 350, Derek, if based on your slide, or is it against the full? So it's just 30% of 350, or is it 30% of the full project, but can't be above 350?
Okay, so the way that the limitation that I was working, essentially you calculate that when it is.
Derek, I think I'm having trouble hearing you. Something happened to your audio.
Is it any better?
It kind of sounds like you're like a fly buzzing around in my ear. I can't fully hear the
I
audio.
can answer that, and Eric, you can nod if you want. Yeah, it's against the full million, and you can't exceed the 350. So it's against the full million project. Is that correct, Eric?
Okay, thanks, guys.
Great question. Thank you for the clarification. All right, we've got 5 minutes left, and we have a lot of experts in this meeting. Is there anybody else that would like to take advantage of this time here and ask final questions?
And I want to make a comment at the end on the furtherance of another workshop. Okay.
Mm-hmm. All right, Bob, I think the floor is yours now.
My heavens, I think I scared everyone away. So, well, anyway, one, this was put together with the Energy Administration and with the Rural Maryland Council. And we put together some of the workshops that, working with Lacey to help encourage in the more rural areas around the state, the 5 regions, applications. So, and that was, I think, helpful to them, and it was an interesting exercise in getting the word out on what I think has been a great program from the Energy Administration. And it's set up in a very simple, straightforward, easy to administer. I'm sure it's very easy for you to administer this, Lacey, right? So at any rate, we put that out, got good responses for it, and then wanted to use this workshop or webinar as an example of why we need to pay attention to. You've got projects now, you've got funds from the Energy Administration, but if you're not paying attention to these safe harbor and others, you could lose a great opportunity to leverage this out in other ways. That's why we wanted to push this. We're going to do a follow-up with these out to the recipients. What I would like to do is structure it through each of the rural Maryland, the 5 regions of the state, so that we can provide some additional information and, if necessary, hold workshops or in person in furtherance of this at locations in the 5 regions. The other is that we've talked about and included in our earlier presentation a little different approach to doing some of the procurement contracts, one of which was a way in which a jurisdiction, particularly we're talking about the smaller ones, jurisdictions might be able to create a contract going through the bid process, but to create a contract that is usable by other jurisdictions. In other words, they could piggyback on to that without having to go through their full regular procurement process. As a very simple example, many of the counties and jurisdictions participate in a joint purchase program for vehicles, particularly public safety vehicles. So they buy in through the pool. This is a similar approach to that. We're going to offer a workshop, I say workshop, I guess one of these webinars that touches on that and how it would work. The Rural Maryland Council has a very large health-related grant process that's just started, and I've been dealing with Charlotte on how we might apply this to these smaller jurisdictions for these health-related grants. But I think it could equally apply to this. So I don't want to confuse things and mix too many subjects here, but just saying that we're going to put another one of these together very shortly, certainly between the Rural Council, and I would certainly hope or ask Energy Administration as well, if they feel comfortable with that, to participating in it. So I just want to tell you there's another element to this that I think could be helpful that we'd like to try to roll out and at least invite you to find out how it might work for you. So that's my talk.
Awesome. Thank you so much, Bob.
I want you to know I provided all of the refreshments for today's meeting.
Providing refreshments, you're always thinking about the big picture. We really appreciate working with you. Closing thoughts, I do want to say, real quick fun announcement. We will be launching a request for information for our new commercial building program. We're still designing it. It's not going to be LGM anymore. That was kind of like a one-time funding opportunity thing, but we will still have money for local governments. More information will be coming out soon, but look out for a request for information, and please give us your feedback once that does come out. Thank you so much to everybody that was involved here. Derek, we really appreciate your expertise. James and Bob, thank you so much for coming and providing resources for our local governments. Everybody, thank you so much for joining. Happy to have you here. Please continue to stay engaged with us and let us know how MEA can continue to support you. So on that note, hope you guys have a great rest of your day, and thank you again for coming.
Thank you.